AT&T, ticker symbol T, is currently trading at $27.24 a share. This is a favorite among dividend investors. Currently pays a 4.08% yield. Now that may seem a little bit low, but if we have a look at the stock chart over the last year, it is up 68%. And if we go on the 5-year chart from the bottom, which it was at in the mid of 2023, it is up almost 93%. So is this the right time to buy? Is the stock going to keep going up? Will it continue paying its dividend? What we're going to be doing is looking at the most recent earnings of AT&T and then going to my automated stock valuation spreadsheet to see if AT&T is a buy or sell using the discounted free cash flow model, comparable company models, dividend discount model, and Ben Grimm formula for intrinsic value. So let's just quickly put in the ticker T, and this will load up all the latest company financials so we can have a deeper dive. If you're interested in this, please check out my Patreon. Links are in the description. So let's go back to here as it loads. Currently $27 a share, 195 billion in market cap, a PE ratio of 18.23, which is lower currently than the market average, which is 26.94. Earnings per share $1.49 and a beta of 0.04, meaning it should be a lot less volatile than the market despite its recent increases. And analysts do have it as a slight buy, but pretty negligible, $27.90 a share. Now, yes, as said before, it does pay a very healthy dividend at the minute, over 4%, which means you'll get paid $1.13 per share. Is the dividend safe? Yes, currently it is. In terms of the net income, in terms of the profit, it's about 73%, and in terms of the free cash flow, it's about 43%. They pay out around about 8.1 billion a year in dividend. Now, if you want to get paid your quarterly dividend, buy before the 10th of July. So let's have a look at the revenue numbers here. Ignore the trailing 12 months because this is the full year. So 122.34 billion, pretty much flat the last 3 years. You can see down ever so slightly, but up from 2022. And if we go back to the, we have it here. This is the income statement, the most recent earnings. We have the fourth quarter revenues and the year ended. This is split into service and equipment. We have a bigger breakdown down below. Service up ever so slightly, equipment up ever so slightly. So on the quarter, it was up from the prior one of 23, up about 300 million. And on the full year, down ever so slightly, as we saw. Services is up, but equipment down, which then gives us the pretty much the same, almost flat, but down ever so slightly. So if we scroll down a little bit here, I'll quickly run through these. This is the communication segment. We'll look at the full year. Mobility, largest segment, up 1.1%, 84 to 85.2. Business wireline down about 10%, 20.8 to 18.8. Consumer wireline 13.1 to 13.5 overall. That brings us 118 down to 118.5. Scrolling down again, mobility. This is what we saw before. This is split between service and equipment. Up 3%, down 4%, 63.1 to 65.3, and then down on the equipment side. We also have business wireline down 2 billion. Up ever so slightly. And then consumer wireline, as I said before, is a split between broadband, legacy and other. Legacy and voice data services, other. Broadband up, everything else down. And this is the Latin America segment. Everything is up, but a small amount. So that is it. And as we can see here, this is the full breakdown here. But yeah, everything's looking pretty flat. A few ups, a few downs, but overall it is flat. Everything's netting off. Are they able to generate more profit? Not so much. Margins have decreased, just shy of 11 billion. Free cash flow. Are they generating lots of free cash flow? Well, currently it's 18.5, down from the prior year. But if we look at operating cash flow versus CapEx, you can see operating cash flow is pretty much the same, but CapEx increased a bit, which is why the free cash flow is down. Shares outstanding. They have been buying back more shares, which is good to reward shareholders. So let's have a look at the discounted free cash flow model. This is the way of valuing stocks, like their future free cash flow, discounting them to today's value. And let's see if it is a buy or a sell. So let me just put in the averages. Currently, it's giving us $13 a share. Now let's see if what the numbers, what we agree with. So based on averages, we're expecting declining revenues. Let's see what analysts are saying. Slight increases on the average. Low estimates looks like a slight increase as well, and high estimates. So yeah, I'm going to say we'll do a 1% increase. That brings us to $18 a share. We'll do that and we'll review this in a sec. Net income margins. I mean, I think it's safe to say about the prior 2 years are a better reflection. That brings us to 23. And net income to free cash flow. Well, we've got the free cash flow here. They've got lots of free cash flow. Net income is actually less. So if we did look at the prior year, that'd be 160%. Would be $70 a share. A massive, massive buy. But let's bring that down. We'll even just go 142. And if we look at 2022's number, which was at 86, this still puts us to buy at $36 a share. So discounted free cash flow does have it as a buy. Dividend discount model. Let's see what it says. Well, they've flat. So he's not going to like this. They haven't been growing it. They slashed the dividend in 23, and it's been flat since then. So we're not going to look at that. Ben Graham, formula for intrinsic value, looks at earnings per share, PE of a non-growth company, AAA bond yield, corporate bond yield, and let's see. Well, unless AT&T have quite high growth, which I don't think they will. 8%. So expecting less than the S&P 500. You can see it puts it at about $20 a share. So not too bad, but yeah, massive difference between the price. Okay, finally, let's have a look at the comparable company model. This is the way valuing stocks look at their competitors. A couple that jump out. I mean, the biggest competitor probably is Verizon. Then we'll do T-Moose, which is T-Mobile. And then we'll do Comcast, CMCSA. And what this will do is it'll load up all the latest company financial data for its competitors, and then we can have a look. So it's looking at revenue growth rates, EBITDA, net income, profit margin. I'm going to make this column a little bit bigger. I've added some more columns, so it's hard to fit them on. Let's make 1 year revenue growth rate a bit smaller. Profit margins, price to sales, price to book, PEG, which is Peter Lynch's price to earnings growth, EV to revenue, EV to EBITDA, PE, and forward PE. So this is just taking a moment to load. What I'll do in the meantime is just we'll compare them here. We want Verizon, which is VZ. We want T-Moose, which is obviously T-Mobile. And Comcast, which is CMCSA. And we'll go over the last year. So you can see AT&T is up the highest. T-Mobile, pretty close. Comcast is down and Verizon is down. And if we go over the last 6 months as well, AT&T, T-Mobile on the head. 5 years though, AT&T up 15%. T-Mobile smashing the market with 118%, whereas Verizon and Comcast are down. Let's just see if this is loaded. Oh, it's being slow. God damn it. I'll just do another stock quickly, and then I think I'm putting too much data, stressing the system. It is still loading though. Okay, now we'll go VZ. Well, actually, what we'll do in the meantime, T-Moose, and then we'll go VZ. Okay, while this is loading, we'll just quickly compare AT&T versus T-Mobile specifically. Enterprise value, T-Mobile is larger. Revenue, AT&T has higher revenues, but in terms of 5 year growth rate, AT&T is down, T-Mobile is up. EBITDA, higher. Net income, about the same. Profit margins, T-Mobile has high profit margins. Price to sales, price to book, and PEG, AT&T is lower, which means it's more undervalued. EV to revenue, lower. EV to EBITDA, lower. PE, it's lower as well. If you look at an average of all these, it puts us around about $42 a share. So if you were to compare versus T-Mobile specifically, it would be a buy. So that is the Ben Graham says it's not a buy. Dividend discount model, not really useful here. Versus T-Mobile specifically, it's a buy. Discount free cash flow model says it's a buy as well. Why are these not loading? Comcast is there. It's loaded half the stuff. Wonder why. Very strange. Let me do another one as well. We've also got LM Lumen. Okay, I'm guessing the API isn't playing today for some reason. But we were able to compare against T-Mobile, which is probably their largest, one of their larger competitors, one of them closer competitors. Right, guys, thanks for watching. Please give a like on the video if you enjoyed, subscribe if not already, and I'll catch you guys next time.